All right, today we're going to do something a little different. This is a professional case study. We're going to walk you through the exact rigorous process we use to decide whether to put serious capital into a company. And our live example for this is Shilchar Technologies. So this is really the million-dollar question, isn't it? It's not about chasing hype or getting lucky. It's about having a system, an unemotional process that helps you find the real signal in all the noise out there. We're about to show you exactly how that works. The very first thing you do is apply a strict framework, basically a checklist. This has nothing to do with feelings or what the market's excited about this week. It's a cold, hard filter designed to find companies with the bones of a long-term winner before we even think about spending more time on them.
So the company we're putting under the microscope today is Shilchar Technologies. They're in the business of making transformers and power electronics. The question is pretty simple. Can it pass our tough initial screen? Let's find out.
Okay, this is the first gate. We're just going to run a quick check on the most critical numbers. If a company fails here, we just move on. No second chances, no exceptions. It's all about being efficient and disciplined with our time. First question, and it's a big one. Do the founders and their family have serious skin in the game? When you see high promoter holding, it means their interests are aligned with yours as a shareholder. They're not just employees, they're owners. And the answer is a big, resounding yes. At around 63%, Shilchar clears this hurdle with plenty of room to spare. This tells you the people who built this company are still deeply invested in its future. That's a strong pass.
Okay, next up, how good is this company at actually making money from the capital it has? Return on capital employed, or ROCE, is a fantastic measure of how well a business is run. We're looking for something north of 20%.
And wow, this is where things get really interesting. Shilchar's ROCE is an incredible 71%. I mean, let's be clear, that's not just a pass, that's an absolutely exceptional number. It signals a company that is just a highly efficient profit-making machine, a massive green flag. Now for the balance sheet. Is the company fueling its growth by borrowing a ton of money? You know, high debt can be a killer, especially when the economy gets rocky. We want to see a company that's careful with its borrowing.
And again, Shilchar passes with flying colors. The company is pretty much debt-free. That kind of financial strength gives them incredible flexibility to handle problems, jump on opportunities, and just run the business without a banker breathing down their neck.
So as you can see here, Shilchar doesn't just pass one or two of our checks, it passes all of them. The full screen has 13 points, covering everything from sales growth to cash flow, and it aces the whole test. Now, that's incredibly rare, and it absolutely earns our full attention for a much deeper dive.
So the numbers look fantastic. But that's just the what. Now we need to understand the why. A great quantitative screen just gets you in the door. Now we have to understand the business itself, the story, the strategy, and the competitive advantages that are generating these amazing results. A huge piece of that puzzle is their revenue mix. You can see that over 40% of their business comes from exports. Now, why does that matter? Well, it's not just about spreading your risk geographically. Those export deals often carry much juicier margins. It's a real engine for their profitability. So what's stopping competitors from coming in and eating their lunch? Well, it's what we call a competitive moat, and it has 4 key parts. First, they have a deep engineering pedigree. Second, they've got all the quality certifications you need to play in the big leagues. Third, and this is so important, their customer cycles are long. Once you're designed into a power grid, the cost to switch you out is massive. And finally, they've proven they can expand efficiently. It all adds up to a really durable advantage.
And you can't forget the people running the show. We looked at their recent conference calls, and the takeaway is clear. This is a team that's all about execution, not hype. They give straight answers, and they deliver. In this business, credible leadership is just a priceless asset.
Okay, so we've established that it's a high-quality company, but now we come to the part that can make or break an investment. What's it actually worth? This is where we figure out if the price is right and get brutally honest about the risks.
Let me be super clear about this. You can find the best company on the planet, but if you overpay for it, it's still a bad investment, period. So the most critical question now is, does the current price make sense based on a conservative view of the future? To figure that out, we put together a pretty conservative financial model. We're not using crazy optimistic numbers here. We're assuming growth will slow down, we're using a reasonable discount rate, and the result? Even with these sober assumptions, the current market price seems to be in a reasonable range of what we think it's worth. So it passes the valuation check. But, no investment is a sure thing. We have to be brutally honest about what could go wrong. If raw material costs like copper or steel spike, that could hurt margins. A sudden change in U.S. tariff policy could hit that important export business. And those sky-high returns, they could eventually come back down to earth if competition heats up. You have to watch these things. And that brings us to what I call the kill switch. The one metric we have to watch like a hawk is that ROCE number. If we see that start to fall consistently, that's a direct signal that the company's competitive advantage, its moat, is cracking. That would be our trigger to get out, because the whole reason we invested is no longer true.
All right, so after running it through the numbers, the story, the valuation, and the risks, we can finally put it all together into one clear, actionable conclusion.
So here it is, the bottom line. Shilchar is a high-quality, very disciplined manufacturer with a solid order book and a reasonable valuation right now. We see it as an investable, long-term opportunity where the potential upside seems to be much greater than the risks we can identify. It's something you have to monitor, for sure, but it's a compelling setup.
And this is how a professional firm would actually put money to work. You don't just dump it all in at once. You'd go in stages. You start with maybe a 30% position. Then you add another 40% after the company proves it can maintain these high margins. And you deploy the final 30% when you see more orders coming in or if you get a nice price dip. It's disciplined, it's evidence-based.
So, I'll leave you with this to think about. We've laid out the big risks: material costs, tariffs, margin pressure. If this was your money, your call to make, which of those would keep you up at night? What's the one signal that would tell you the story has changed? That's the kind of thinking that separates disciplined investors from the rest.